Respected Mr. Shome, considering your vast experience as an industry veteran, it would be a great opportunity if you share a few thoughts of your how industry should should deal with the current twin balance sheet problem.
So, what I understand from your question is that currently private investment is still depressed
So,
because company balance sheets are stressed because of maybe excessive leverage from legacy loans. And banks are also still facing problems in their portfolio. So, these are the two reasons why you can say that investments in the private sector have not picked up. But I think you have to look at two different areas where this problem emanates from. I think one is that demand itself needs to go up before anybody will make investments. So investments really have, if you see this, two essential parts. One is there has to be demand in various sectors for people to find it interesting to invest. So I think that's an important factor. There has been some amount of excessive investment which is now working its way through the economy. So as demand picks up sector by sector, you will see at least the need for investment to go up. The second is that, and we've heard this several times in the recent past, is that a lot of the investments were, longer term investments were being funded by banks, which if you think about a banking sector, a lot of the banking sector liabilities are shorter term, whereas a lot of the assets were much longer term. And all developed capital markets essentially have a laying off of risk or longer term risk going into public markets, which is basically the bond market, maybe the convertible market, and then finally the equity markets. I think the whole institutionalization of savings, which in the past, if you look at India, banks were effectively the intermediaries. So savings were sequestered by the banks, and the banks were then, doing intermediation or really, maturity transformation, as it's called. Uh, but I think the maturity transformation and the defeasing of risk needs to go beyond just savers and go to institutional investors. And so, as you know, both SEBI, RBI, and the ministry has been working on developing the capital markets, especially the bond market. And I think the signs recently are much more, encouraging as the public market investments are picking up, and institutional investors are able to, both onshore but also offshore institutional investors are able to participate. I think that's really the way to get to the solution of this twin problem.
so industry is saying repeatedly saying that the public investment it is not as were expected. It should be more. Do you believe that?
I think public investment cannot be switched on overnight. So I think there's a lot of intent. I think government is within the constraints of keeping the fiscal deficit under check, still committing a lot of investments. But I think again, I have a slightly different take on this. I think it's not just the quantum of investment, but the efficiency of investment. And if you talk in economist terms, really the I-core, which makes the effectiveness of the every rupee or dollar that you invest,
So,
how does it come back? And I think the fundamental changes the government is doing, so that amount of money that is being spent, if it goes longer, if
so
you will, is more effective, and the leakage and the wastage goes down. The same amount of public investment can create much more and create really the opportunity for then the private sector to participate. So I think that we are in a good spot.
so
Thank you.
many thanks, sir.
Thank you.